All right. So, let me hand these back and then let's talk about them. I'm drawing a blank about the high scores that you could possibly have gotten in this additive, so don't get unnerved if you see. You just, I think the high scores that you could get were something like 66 points or something like that. Okay, so high score 66. If you got in the 50 range, like let's say 45 to 55 B range, anything above 55, more in the A minus range, things like that. 45 to 40 B minus range, somewhere in there. Again, most of you know, guys, I don't give grades to this. The final exam will be more heavily weighted. It will be cumulative. It will be in the same style, a bit longer than this test. It will have somewhat of the similar kind of problems. Obviously, we'll explore more of the grantor trust rules, some charitable questions, some IRD questions. Okay, but certainly you would want to know. I feel it's fair game when we go through the midterm to go through some of the things that we go through here. You'll see very similar problems. So pay attention right now. Okay. If you want to review your multiple choice, shoot me an email on next week or the week after. I think, by the way, no one's going to be surprised by this. The Wednesday before Thanksgiving, we do not have class. I know you're going to be disappointed to hear that. But the Wednesday before is traditionally, I think they treat that day as a Friday. I'm pretty sure. Let me not say I'm 100% sure, but I'm 90% sure. Okay? I'll confirm that. So, wait. CJ. He's a you're here. You're here. Anthony, you're here. Brett, you're over here. David. David's here. Tina, Bakery. Coming on. Question. Jimmy's here. Tina, there's Jones here. Yeah. Let's just see what people got right and what people got wrong. Right. Let's go through this. Again, the simple trust has the following receipts and expenditures for the current year. Long-term capital gain and the trustee's fees are part of principal. Okay? What is the trustee and I? So, what do we do to compute D&I, guys? What's our starting point? Taxable income. So, we take, what do we add together here, Jill?
20,000 dividends.
Fine. I think the penny doesn't work. Right?
15,000 capital gains. Take out the 1,500 the trustees' fees because none of it is tax on that. And then you can take out the $300 entry too.
Okay, so this is the tentative taxable income. And to compute D&I, what do we need?
Add back the exemption,
Add back the exemption.
and then the long-term capital gains not included in the distribution. That was at 18.5.
Okay? That's it. Right, you look perplexed. You got
No,
that?
I got that.
Okay.
It's my general look, I suppose.
Again, guys, it wasn't, I try to keep, this course is, the material here, guys, is not easy, okay? But I try to, whether or not you believe me or not, I try to keep the exams of it, 1 being the easiest, 10 being the hardest. Keep it at a 2, 3, or 4 level, okay? I'm not here to trick you, I'm not here, just basic stuff that we covered. What's the trust taxable income? Okay? Well, if this is the tentative taxable income, right? This is the tentative taxable income, right? So we take that and reduce it by the distribution deduction, right? It's a simple trust. A simple trust pays out all of its income. Everyone agree? But it's capped by D&I, right? So even though the distribution to the beneficiary is $20,000, we can't deduct $20,000, right? So we take $33,200 and we reduce it by 18.5. Right? And then question C, what is the income taxable to the beneficiary? And again, if you look up at the ceiling, it's limited to the D&I, right? Or 18,500. CJ, what's the right? All right. Nothing tricky, right? I wasn't looking for anything tricky. Question 1, I really try to keep straightforward. I mean, I try to keep question 2 straightforward, but just took it up a notch. How do we take it up a notch? We introduce tax exempt income, right? How would your answer to part A change if the trust in addition received $8,000 of interest from tax exempt bonds and distributed 28 instead of 20, right? So here, let's put this side by side. $20,000, right? And we're trying to figure out tentative taxable income, so we include capital gains. But here, what do we do in terms of the $1,500 deduction? Can we deduct all $1,500? And the answer is
No.
no, right? You remember Manufacturers Hanover? We had to take tax exempt over what? Taxable income, right? We didn't, under Manufacturers Hanover, right? We didn't include capital gains in the denominator. Everyone agree? Times 1,500 equals what? 429. That's the amount that's disallowed, right? That's the income attributable to the tax exempt. Agreed? So what's deductible here? And, what were you gonna say?
Aye.
What else do we need to do?
The exemption.
Exemption. So what's the number here? 33,629, right? Now, to compute D&I, what do? We subtract out the capital gains, right? We subtract, or we add back the personal exemption, and we have to add in, right?
Net tax exempt income.
Net tax exempt income, right? So we don't add in the full 8,000, we add the net tax exempt, and the answer here $26,500. I mean, this is straight from, you know, the examples on page 56 and 57, guys. This is it. If you just took out those 2 pages and used it, you got this answer. And I apologize if you didn't think I was being original. Okay? And this is the D&I. What's the trust taxable income? Well, you take this number, right? Plus the income distribution deduction. What's the income distribution deduction? We have to, on Schedule B, you have to subtract out the tax exempt income, right? Can't get a deduction for it. So the income distribution deduction is $18,929. So to compute the taxable income, you take 33,629. You take out the income distribution deduction, and come up with what number? 14,700. By the way, if you just eyeball this with never coming to class, what would you probably have said is the trust taxable income? 14,700. Why? It had capital gains of 15,000, right? All the other income was going to be distributed out. Gets a $300 exemption, right? It's a simple trust. So you probably could have eyeballed this and said, oh, 14,700, right? So we're going to have this as the taxable income. What amount is in character is the beneficiary taxed on? Well, on the tax exempt that the person got, 8,000 less 429, that's the amount disallowed. So, or the amount of expenses allocable to the tax exempt, 7571. And the dividends, 20,000 less the other trustee commissions, 18,929, and together it adds up to the D&I of 26,500. Right? Questions? Question 3. The trust is authorized to make discretionary distributions of income and principal to its two beneficiaries, Roy and Sandy. Separate shares are not required. For its current year, it has D&I and accounting income of $80,000, all from taxable sources. Distribute $60,000 to Roy and $40,000 to Sandy. So we have a trust. It's authorized to make discretionary distributions. So is it a simple or complex trust, guys? Complex. Everyone agree? What's the controlling code sections here? 661 and 662, right? Are these tier 1 or tier 2 distributions?
Both tier 2.
Both tier 2, right? Discretionary. Agreed? And there's 80,000 in D&I. And it's going to pull out proportionally, right? It's going to pull out proportionally the D&I, right? The larger the distribution, the larger, right? With tier 2, the larger the distribution, the more the D&I. Agreed? So this was a matter of just saying, hey, Roy gets 60%, Sandy gets 40%. What's 60% of 80,000?
48.
48. And what's 40% of 80? 32. Everyone got that? Go ahead, Yoni.
I think I wrote that, but you wrote
During the break, what did I put?
S-T-E-T.
T-E-T. After class, come by. Maybe I screwed up. All right? Next question. How would your interest change if the trust instrument required $10,000 a year be distributed to Sandy, and the trustee also made discretionary distributions? So 60 to Roy and 30 to Sandy. Are there tier 1 and tier 2 distributions here?
Yes.
Yes, right? What's the tier 1? Sandy gets the tier 1. Everyone agree? Everyone agree? Sandy pulls off the first 10,000, right? How much D&I is left after that?
70.
70. Okay, and how much remains tier 2? 90, right? $90,000 in distributions. So isn't it 70 times 60 over 90 for Roy, right? The remaining D&I gets split 60-90. Agreed? So Roy is taxed on $46,667.67. Sandy is taxed on 70 times 30 over 90, plus $10,000, right? Because the first 10,000 is taxable to Sandy. The tier 2 is 70 times 30 over 90. Everyone got that? That's important. Everyone should be able to handle that. No questions asked. Val, you got that?
Oh, yes.
David, you got that? Question 5. The T Trust has receipts and expenditures listed below for the current year. The trustee's fee is charged 1/2 to principal and 1/2 to income. What is the trust fiduciary accounting income and the maximum amount it can be distributed? Assume the trust cannot pay out principal. Okay. So what things did you guys add here together? Dividends, right? Interest, right? Rental income, right? Property taxes we have to subtract. And the trustees' fees, what do we say? 1/2 is chargeable to income, so we have to reduce it by 900, right? So you take 15,000 plus 7,000 plus 6,000 minus 1,000 minus 900. I was looking for 26,100. Okay. Assume in problem 6, The trustee may pay out of its income currently to its beneficiary. Okay, what is the deductible portion of the trustee's fee? Okay, once again, we're gonna have to do a fraction, right? Just like we did in manufacturer's handover. So which portion is disallowed? What's the numerator and denominator?
7/28.
7/28, right? Everyone agree? 7/28? Times 1,800? 7/28 times 1,800, the non-deductible fee is 450, right? If you do the arithmetic. So what does that mean? That's the non-deductible, that's the amount attributable to the tax exempt. That means the balance would be deductible, or $1,350, right? So the deductible trustee commission is $1,350, right? What's the trust tentative taxable income exclusive of the distribution deduction? Okay. What do we add here? Get this?
15 is the 6.
15,000 plus the 6
Plus the $1,000 property taxes.
minus.
Yes.
Minus the $1,000 of property taxes.
Sorry, I said less. That's why.
Right. Oh, I'm sorry. Trustees, deductible trustees commission,
$1,350 and then the $300 deduction.
18,350. How do we compute D&I? We take this number, we add back the personal exemption, we add in the net tax exempt, and we get 25.2. Questions? And then what is the taxable income? No. We start off essentially with the 15,000. This would all end up on the form 1041 on page 1, plus the rental income, minus the property taxes, minus the trustees' fees. And now we're going to get the distribution deduction, right? We're going to get the distribution deduction. And the personal exemption of 300. By the way, I should do this, I apologize. And it ends up being negative 300. Which is not surprising, right? Because there's no capital gains here. So, if you're having a problem with, this, figuring out these numbers, go back through. I'm hoping by going through it on the board, this becomes more self-explanatory. If you have a problem, shoot me an email and say why you didn't understand something or where your confusion lies. But not to be boring, but I may be, if I take one of these problems and just change the numbers. I'm hoping everyone here could replicate this on the final exam. Okay, I will not, once again, I will not ask you to tell me what the tax liability will be. I simply want to know, what is taxable to the beneficiaries, what is taxable to the trust, and if you can perform these exercises again, I will feel good on my holiday break, and hopefully you will as well. So I would anticipate a question or two or three regarding this kind of, can you do this? Nothing more complicated, okay? Seriously, I'm not going to make it more complicated than a final exam. Right? So if you know it now, you'll know it then, hopefully. If you don't know it now, you should. And if you have a problem, you'll let me know and I can hopefully help. The exam, again, and people have heard this in my other classes, will be more heavily weighted. So if you didn't do as well, now is the time you can accelerate. And if you did well, don't rest on your laurels. Just make sure you perform as well, too. We're a fairly small class. I know, I don't have to give 20 C's, 20 B's, whatever. You're a small class. If everyone shines, so be it. So just try to make it happen. You hold the fate of my winter break in your hands. The better you do, the better I'll feel over my winter break, okay? So everyone has the message? All right. Again, if there's questions or problems, just shoot me an email, call me. I try to respond to everyone's calls, emails, and the like. Ready to go back to grantor trust?
Do you need these back?
I don't need these back.
I can talk to you after.
Talk to me after class. If I screwed something up, just talk to me after class. All right, so we left off with this notion of income, of the assignment of income. We saw the renowned Clifford case, right? And where the court was, I'll call it aggressive, right? People would say, wow, this is activist court, right? That's what in 21st century language it would be called an activist court. But then Congress decided in the aftermath of Clifford, sometimes it takes a big court case to drive Congress into action, and Clifford was of that ilk. And it introduced Subpart E to the Internal Revenue Code. You might as well turn to Code Section 671. By the way, I think I'm thinking of the Odyssey. Is it in the Odyssey where someone steals Helen from Troy, and isn't that the face that launched 1,000 ships? Is that?
Yeah.
Okay, thank you. Okay, so I'm not too far off. Okay, so Clifford, I don't want to know if it's the case that launched 1,000 more cases. Okay. So Code Section 671, everyone has it open. Let's dissect this code section. It's of pivotal importance. Where it is specified in this subpart that the grantor or another person shall be treated as the owner of any portion. Notice it doesn't talk about the whole of the trust, right? That the grantor trust rules may consider the entirety of the trust a grantor trust, or it may consider a portion. So bear that in mind. It's not something, it need not be black or white. It can be gray, okay? It need not be black or white, it can be gray. There shall then be included in computing the taxable income and credits of the grantor, the other person, those items of income, deduction, and credits against tax against tax of the trust, which are attributable to that portion, notice the word portion again, of the trust to the extent that such items will be taken into account under this chapter in computing taxable income or credits against the tax of the individual. So in other words, if the person is treated as owner of the trust, I'm going to paraphrase, essentially any of the income, credit, deductions, or the like end up on that person's tax return. So unlike where we said a trust before or an estate, separate taxpayer, this is the exact antithesis, that all that stuff ends up on the taxpayer's tax return. In contrast, the remaining portion, which is not considered a grantor trust, I'm adding in that language, shall be subject to subparts A through D. All right, so in other words, this is an acknowledgement that if it's not treated as a grantor trust, the rules that we learn in chapters 1, 2, and 3 are applicable. Okay, everyone got that? That it's not a grantor trust, the rules of chapters 1, 2, and 3 apply. It concludes by saying, no items of a trust shall be included in computing taxable income and credits of the grantor or any of the person solely on the grounds of his dominion and control over the trust under Code Section 61 or any other provision of this subtitle except as specified in this subpart. So that last sentence, that's a message to courts. Back off. We're here in Congress. We got it under control. Unless we say otherwise, okay, this is it. Don't use judicial doctrines to make things into grantor trust. In other words, this is the landscape. If we haven't called it a grantor trust, courts, you don't go out and you don't call it a grantor trust based on indicia of ownership, okay? This is a turf war, right? This is Congress saying, hey, court, back off. Well, we got it from here, right? Everyone agree? Everyone agree that was a message from Congress? All right. We're good with Code Section 671. Everyone see? It has 3 missions there. First mission is to say certain trusts are to be ignored. Second mission is to say if it's not ignored, regular rules apply. Third mission to say these are the rules. No other rules, court. We're good? And by the way, what you're going to see throughout chapter 4, unlike all these numbers, one of the hardest parts, or the key aspect of chapter 4, is the process of identification, okay? In other words, if you can properly identify that part of a trust, or all, which is a grantor trust, guess what? You're going to be successful. If you can look through this subpart of subpart J of the Internal Revenue Code and accurately identify those trusts which are grantor trusts, Houston, your mission is over, right? Okay, just keep, it's not really numerical in nature, right? Not numerical. It's identification. Well, you guys have been here down this road before. Before we get into identifying, you need a scorecard, right? And part of the scorecard means you need definitions. What do certain terms of art mean? By the way, throughout the course, I just, particularly this material, there's a fair amount of historical background regarding these code sections. You guys know I am not going to ask a single question. What would have happened under prior law? Do not look for that question, okay? It's hard enough knowing what is current law. I know sometimes people will come up to me and say, did you read the latest Treasury regulations? For example, there's new Treasury regulations that are 30 pages long, single space. I think they're 30 pages long. like Code Section 2704, which deal with minority and marketability discounts. And people said, well, I don't know about you guys, I have enough trouble trying to keep pace with those things that have passed. And particularly that particular regulation that was just promulgated, there's a lot of people saying that it's going to be fundamentally changed or never go into effect. I do not have the time, effort, and energy to read through things that may never come to fruition. So I will not ask questions about what has been. I will not ask you about what do you think will happen in the future. I will ask only about those things as they are today, okay? So I do think, by the way, don't just flip the pages if you see references to the historical part. I do think by learning a bit about the history of these code sections, it will help you better understand what they mean today. So I won't test you, but that doesn't mean gloss through them. Again, that's not probably the proper approach. All right. So Code Section 672 talks about different definitions, because throughout this identification process, we're going to meet with all sorts of verbiage and special terms of art, and you might as well know what these terms of art mean. And these are spelled out early on. What is an adverse party? The term adverse party means any person having a substantial, not a beneficial, a substantial one, notice the qualification there, in a trust which would be adversely affected by the exercise or non-exercise of the power which he possesses respecting the trust. Okay? A person having a general power of appointment over the trust, general power of appointment over the trust property shall be deemed to have a beneficial interest in the trust. Right. So, by the way, let me encourage you, the authors of our textbook give you certain regulations to look at. They're not very long. There's several examples here to help you better understand what an adverse party is. An adverse party is essentially in a trust is where if something is done, they get less. And that creates, economically, they get less. So anyone has an adverse party where they're in a position where if some sort of action is taken, and we'll see some examples of this, they risk getting less. Well, that tension of getting less creates adversity, and they are an adverse party. So if there is a position in a trust instrument where if one thing, if certain conditions are met, someone else gets something less, this party is going to be adverse to that party. You're going to see examples in the regulations, and we're going to see some examples in the problems. And if you're not an adverse party, well, the flip is you're not non-adverse party, okay? That's how the code defines it. You're either adverse or non-adverse. You can't be anything in between. You can be, in addition, a related or subordinate party. Related or subordinate party means any non-adverse party, so it's got to be a non-adverse party, who is the grantor's spouse, if living with the grantor, and any one of the following. This should remind many people of Code Section, for example, 267, member of a family, 267C, right, defines what is a member of a family. We've seen this in Code Section 318 in the corporate tax area, attribution rules. Well, why should this subchapter J not have some sort of, we said, anytime there's related party, antenna goes up. The grantor's father, mother, issue, and surprisingly, right, when we looked at rules, typically they don't include brothers or sisters, but here they do. Brother or sister, an employee of the grantor, a corporation, or any employee of a corporation in which the stock holdings of the grantor and the trust are significant from the viewpoint of voting control, a subordinate employee of a corporation in which the grantor is an executive. Okay? So these are our related or subordinate parties. So those are the three key definitions that we're going to see crop up here. By the way, any discussion of foreign grantor trusts do not worry about. You will not be held accountable. So if you come across this code section 679 that deals with foreign trusts, you'll have enough work here. Don't worry about foreign grantor trusts, okay? If you see reference to them or anything dealing with the word or adjective foreign, do not worry about, okay? So if you want to get your first taste of a grantor trust, let's talk about reversionary interest. Reversionary interest under Code Section 673. So we have 671 defining grantor trust, 672 with some definitions, and 673 with our first glimpse of a grantor trust, right? 673 says, the grantor shall be treated as the owner of any portion of a trust which he has a reversionary interest in either the corpus or the income therefrom, if at the inception of that portion of the trust, the value of such interest exceeds 5% of the value of such portion. So if you create a trust and it can revert back to you, and the value of that interest, actuarially, exceeds 5%, not equal to 5%, exceeds 5%, the actuarial value of that reversionary interest exceeds 5%, the trust is going to be ignored. The entire, well, let me be careful. You'll see, it could be a portion too. That trust, depending on its terms, or you'll see, can be part or whole grantor trust. There is an exception spelled out in 673B. Reversionary interest taking effect at death of minor lineal descendant beneficiary. In the case of any beneficiary who is he a lineal descendant, not descendant of the grantor, and holds all the present interest in any portion of the trust, the grantor shall not be treated under subsection A as the owner of that portion solely by reason of a reversionary interest in such portion, which takes effect upon the death of such beneficiary before the beneficiary attains age 21. So if you have a reversionary interest in a trust, but it's only effective while that person is under the age of 21, that will be ignored no matter what the value of your reversionary interest is. So the point is, many parents set up trusts for their children, and there could be terms that say, hey, if my child dies prematurely, I get the money back, right? Everyone get the visual? And that could be worth, depending on interest rates, could be worth more than 5%, right? But that will not trigger a grantor trust status.
That 5% rule, what exactly are we comparing? We're comparing the grantor's reversionary interest to...
What is the value? In other words, you set up a trust, Dill sets up a trust, and he has some sort of reversionary interest.
Okay.
How? And let's just put $1 million. Dill's putting $1 million into that trust, right? Everyone's got the visual?
Mm-hmm.
Puts in $1 million, but he retains some sort of reversionary interest. At the end of 20 years, it comes back to Dill, or it comes back to him. He sets it up for my lifetime. At the end of my lifetime, it goes back to Dill, whatever's in that trust, right? How much would Adrian be willing to pay Dill to buy that reversionary interest? That's the question. If I put in $1 million, would Adrian be willing to pay more than $50,000?
Okay.
And Adrian will, look over my health, right? If it's a lifetime trust for me,
Mm-hmm.
well, first he doesn't have to look over my health. I could be dying today; it doesn't matter. He will look at the actuarial tables
Right.
based on my age and the interest rate. He will make a computation, albeit that's what the code instructs. Adrian, being an investor, he's gonna look me up, like to get my blood report and things like that, see how close to, my maker I am, right?
Okay.
Everyone get that? That's a reversionary interest. Dill has not given away the entirety of the property, right? If he's given away that $1 million and he can never ever touch it again, okay, he has no reversionary interest.
Right.
But if there's a chance that the assets of the trust will go back to Dill, that's a reversionary interest. Everyone agree? And if the value exceeds, in my simple example, more than $50,000, it will be considered a grantor trust. Agreed? Anthony, you got that? Now, this is important. Under prior law, how is the statute written? Look at page 263. Old 673A provided that the grantor would be treated as the owner of any portion of the trust, possession or enjoyment of which, quote unquote, will or may reasonably be expected to revert to the grantor within 10 years of the creation of the trust. That's how it used to read. Not this 5-year stuff. Excuse me, not this 5% stuff, right? Everyone agree? The old law used to be predicated based on a more than 10-year. So, how long did people set up trust for?
11.
How about 10 years and 5 minutes?
Okay.
Truth be told, they set it up for 10 years in 2 days or something like that, right? And I have to say, that lasted for many years. And that, by the way, what got the moniker, what did people call these trusts that were set up for 10 years and 2 days? Clifford trusts. Those were the traditional Clifford trusts. To me personally, I'm astounded that Congress allowed Clifford trusts such vitality for decades. I mean, I have to say, if you were a taxpayer during the 40s, 50s, 60s, 70s, 4 decades, and you didn't set up a Clifford trust, it was almost, if you were an accountant and you didn't do that on behalf of your client, it was sort of like akin to malpractice. I mean, it seems to me, I don't know why Congress allowed that to be perpetuated, because everyone could save Joe's six-pack. And I think that's what ended up happening, is that it took several decades for Joe's six-pack to say, hey, I want in on this. And finally Congress said, you know what, it's just ridiculous, right? People were setting these up all the time. And yes, it created a lot of activity in the 1041 area, but it is senseless. It's just pushing paper, right? But everyone can see that it used to create tremendous tax savings. All right, and they went through.
Would they essentially treat that as like a savings account almost? Obviously you wouldn't be able to keep putting money into it, but you just set aside X amount of dollars for.
Just set aside X amount of dollars. You knew it was coming back to you.
Right.
And you knew it was either going to be taxable to the trust or to your children. There's no kiddie tax.
Right.
Or do you depending on the year, even before joint returns to your spouse. What a home run,
Okay.
right? So there's a lot of history here. Again, I'm not going to hold you accountable for it. But on page 265, talks about the current version of 673. Okay? And you can read it. I mean, we just read the statute, but you can read the author's prose here. And the authors add on the next page, page 266, they add the fact that Congress now has fixed, under Code Section 7520, They have new actuarial tables for valuing terms of years, remainders, and reversionaries interest. And just, you know, every month, there's a new 75/20 rate that's promulgated by the IRS. I believe, but someone can quote me, no one has their computer open where they can Google it. Oh, maybe you do. Brett, can you just type in October, well, the November 2016 75/20 rate? I'm just curious. I'm going to make up a number. Let's say it's about 2.2%. You see it there?
There's a table, 120% of that.
Right, but at the very bottom of that table, it should say the current 75/20 rate is.
I don't know if this is right, you're way off for November, it says 1.6.
Okay, it's 1.6%?
Yeah.
All right, I'm not, if you don't mind me saying, I'm not way off, I'm off, but it's very low. Okay, it's needless to say, it's at historic lows. I thought it was low, I didn't realize it was that low. So that's just because the interest is so low these days. 1.6% is the current 75/20 rate. In fact, when they initially published these tables, they went down to like 4%. Back in 1989, it was inconceivable that interest rates would go this low. Interest rates back in those days were hovering at 17, 18%, okay? So the fact that no one would have fathomed that interest rates that there would be a 75/20 rate of 1.6%, all right? So, and we'll look at the tables and I'll go through some examples here. Okay, so, and by the way, the very last sentence on page 266 says in the tax reform in 1986, Congress enacted Code Section 672E, which treats the grantor as holding any power or interest held by the grantor's spouse. Okay, so not surprisingly, grantors and grantor spouses are considered each other's alter ego, right? All right, so let's look at these problems and see if you guys get your first taste of the grantor trust rules. And notwithstanding, again, I know the authors asked you some historical questions. It's worthwhile knowing the answers to those because I think it helps you understand what are the answers to what should be the answers today. So the first question says, in 1985, G creates an inter-vivos trust. All the income is to be paid to G's sister for 9 years. The year after the trust is to terminate, and the principal is to be paid to G. Okay, so after 9 years, the principal is to be paid to the grantor. Does Code Section 673 treat the grantor as owner over any portion of the trust?
Yes, it's under
So-
10 years.
Let me just ask Patrick, what do you think? Yeah, right? Because under the old law, it had to be at least 10 years, right? Had to be more than 10 years. Here, it's only 9 years. So even back, and remember, this law became effective, the law, our current law, became effective in 1986. It was not retroactive. So if you had established a trust in 1985, not surprisingly, Congress had grandfathered that in. The only thing I will say, I'm thinking this out loud, I never really thought about this. The joke was on people who set them up. Why? You set this up in 1985, right? And your trust starts earning income, right? It's not a grantor trust.
So the trust gets it.
All of a sudden, the trust is going to get hit with a very high tax. Oops, not the best of planning. So probably to alleviate that, they probably distributed out the income to whomever was the beneficiary. So essentially, even though you might say, ha ha, we got the trust in under the wire, for all intents and purposes, it backfired. Everyone agree? Didn't really pan out. In '86, they instituted the kiddie tax. So even if it ended up with your children, they weren't going to pay the lower rates too. Assume the facts of problem 4-1 said the trust is to terminate 10 years and 30 days. Okay, is it a grantor trust? Is it a yes or no, Dale?
No.
It's not a grantor trust. You sure?
Yes.
Okay. Would you agree, Lisa?
Yes.
Not a grantor trust. Jenny, agreed? Let me just point something out. Don't be so quick to write that in your notes. Why? Look together and click in 677A2. Let's look at 677. Income for the benefit of grantor. Everyone see that? Code section 6. It's another identification code section. The grantor shall be treated as the owner of any portion of a trust, whether or not he is treated as such owner under code section 674, whose income, without the approval or consent of any adverse party, is or in the discretion of the grantor or non-adverse party or both, may be, look at A2, held or accumulated for future distribution to the grantor or the grantor's spouse. Notice what's going on in 4-2. What about, we said all the income is distributed to the sister. What about capital gains? Who's that going to end up inuring to, Anthony?
Trust.
To the grantor, right? Isn't the grantor going to be the benefactor of any capital gains? Who should be taxing? Who's going to, shouldn't, if you look at code section 677A2, shouldn't he be taxed on it? So this is a grantor trust as to the corpus, as to the principal. So it's not a grantor trust as to the income. It would, under old law, be taxable to the sister. But as to principal, it would be a grantor trust. 4-3.
So, sorry.
Go ahead.
That would mean that G gets taxed on the capital gains as they occur throughout the 10 years?
Yep.
Okay.
So Dill asks, will G be taxed on the capital gains? And the answer is yes, as they occur, not at the end of the trust term. Question 4-3. Assume the facts of problem 4-1, okay, except the trust is to terminate upon the death of the sister, and the sister is 99 years old at the time the trust was created. So actuarially, doesn't look like the sister's going to make it, right? But the term of the trust is for 10 years. Hold on, the same facts as 4-1. On 4-1, we already said that it doesn't qualify. It's going to be a grantor trust. So let's just take 4-2, okay, where it's for 10 years and 30 days. Do we look at the author's point is, do we look at the actual age of the beneficiary? And the revenue ruling they cite to under prior law, revenue ruling 55-34, says you ignore the age of the beneficiary. So the outcome would be the same as in problem 4-2. So it doesn't matter how old the beneficiary under prior law was. All right, but all this is moot. Let's get into the real stuff. And I know 8:45 is not a good time to get into real stuff, but sorry. So give me a few more minutes and then we'll call it a night. 4-4. This year, 2016, grantor creates an inter vivos trust, and just remember, inter vivos means during life as opposed to a testamentary trust, which is on death, right? Inter vivos is during life. All the income is to be paid to the grantor's sister for 10 years and 30 days. Hereafter, the trust is to terminate and the principal is to be paid to G. The 673 treat G as the owner of any portion of the trust. So in this case, Rashida, Tina, what do you think? Is this a grantor trust or not? What's your instincts? Rashida, Tina, what do you think? Yes or no? Rashida? You're whispering, Mrs.
I'm not sure if it might be this.
What's your gut? Grantor or not? You're whispering.
Grandfather.
Grantor. Tina, agree or disagree? Agree? Yoni, agree or disagree?
Gonna disagree.
You say not. If you say not, just tell me why.
For 10 years and 30 days.
So, why are you saying it's not a grantor trust?
Oh, it would be a grantor.
You're saying it would be.
Yes.
Why?
Over 10 years.
But if it's over 10 years, suggests that it would not be a grantor trust. So you're saying it's a
My
grantor?
original answer.
So you're saying it's not a grantor trust?
Yes.
And these that you say it's a what?
I'm not saying.
You're not saying it. David or? Yeah?
Yes.
That's why, grantor trust. Why, David?
This section 673A applies.
Why?
The principal is paid to G.
What do you say it applies?
When the trust is terminated, the principal is going to pay.
Is the reversionary interest in excess of 5%?
No.
What do you think it is? Where would you look to find out if the reversionary interest is greater than 5%? How much would you pay if $1 million was put into a trust, okay? And you were to, Dill set up a trust, right, with $1 million. Adrian, after 10 years, I got the income for 10 years, if you get the visual. Thank you, Dill. He's going to give me the income for $1 million. After 10 years, it goes back to Dill, right? How much would you be willing to pay Dill to get that interest, Adrian, approximately? If he now wants to sell his reversionary interest, make up a number. What are you going to pay for that?
100,000.
100,000. David, how much might you pay? You wouldn't pay? Why wouldn't you pay anything for that, David?
Probably
Just say it loudly. Just tell me your rationale.
5% value.
But put a real number to it. He put $1 million into trust. Jenny's the trustee. She pays the income to me for the next 10 years and 30 days. And at the end, he's going to get back whatever's in the trust, and he's willing to sell it to you. It's not a bridge.
Probably pay
So how much are you going to pay him for that?
Probably pay $1 million.
How much?
$1 million.
$1 million. Did I hear you say $1 million? Sal, do you have a number?
I mean, 300 someone.
And by the way, I know we all, if you could pay Dill $1, why not? But I'm saying let's be reasonable, okay? Obviously, it's in your economic interest to pay him as little as possible, but Dill's a savvy business guy. He's not going to sell it to you for $1. So you got to come up with a reasonable number. Anyone, Anthony, you feeling comfortable?
I probably think about $800,000 to $900,000 based on current interest rates.
That's probably the right number, okay? I think Anthony's got it. In other words, I actually think the right number, is probably like 950,000. Interest rates are so low. In other words, the higher the interest rates, the more Solid benefits, right? Everyone agree? Because Jenny's the trustee, she takes the $1 million, and suppose interest rates just happen to be 20% per year, right? Really high. How much is Solid going to get approximately annually? $200,000, right? That means that after 10 years, that money isn't worth that much, right? The money, if you bought that from Dill, the inflation rate is so high under time value of money concepts, not worth that much, agreed? So you're going to pay Dill a pretty, maybe you'll pay him $100,000, some low amount. In contrast, with interest rates being, let's say, very low, 1%, how much is Solid going to get a year? $10,000 a year, right, of interest. That means after 10 years, that $1 million is still worth close to $1 million, right? So the reversionary interest is probably worth about 95%, right? So there are tables, guys, okay, in the back under 2031-7D. 2031-7D. If you want to take a look at this, 2031-7D, there's a table B. Everyone see table B? Regulation 731-7D. And you'll see it has term interest for a year, and it goes up to 60 years. Everyone see that? You see it in the back of your book? Adrian, you got there? I'm looking at regulation 2031-7D. And my book, it's page 1613, but my version and your version may be different. Adrian, you having problems? David, you got it? Everyone? Okay. And Adrian, after class, if you can't find it, let me know. But because you're going to need to find this, maybe I'll ask an exam question where. You'll find it? Okay. So if you look at the 10-year terms, okay, here, and interest rates at 4.2%, the 10-year term, the reversionary interest is about 66%. As interest rates go up to 6% from 4.2%, the reversionary interest decreases to 55%, right? Everyone see that? The higher the interest rates, the smaller the reversionary interest is worth. All right? So here's my message, guys. We're going to revisit this because I think it's important conceptually. And I don't want to rush through it. So we'll start off reviewing this. And we're just going to march ahead with chapter 4. I don't know. Remember, next class we're going to be a little bit longer. I don't know exactly how long we'll go. But if you want to go, who am I to stop you? Like to page 317, it can't hurt. I don't